This thing is very, very important. This module, very, very important. This is the key, right? That is holding your program. Very, very important. Take it serious, right? So yesterday we talked to this right yesterday, haven't we? Did we discuss this yesterday in your class? You weren't here. Did we talk about this yesterday? Okay. So what we are trying to say is this, right? What make up the income and expenditure of a new business, right? When you are running a business, obviously you need to spend money. Hello, listen. You need to spend money. That constitutes the part of cost, right, to your business. For example, if you are doing a retail business, you buy stock, right? When you are buying stock, you pay for it. It's a cost to you, right? Then when you sell, then the money comes back. The money that will come back to you, not only the money you expended in buying the product, of course, there should be a certain percentage, right? Or a certain amount on top of your cost price or on top of the money you use to buy your product for you to make profit. Does it make sense to you? Right. That is what we are trying to discuss now. We got cost, the total cost of the business, right? Which is made up of fixed cost and variable cost. Right. For example, I have a business. I've got a shop where I'm selling my product. I'm paying rent for the shop. That one is a fixed cost to me because even if I said too a lot or I said less, it's the same rent I'm gonna pay, right? Even if my business is not doing well, I'm gonna pay the same amount of rent. If the rent is 3,000 rand a month, I must pay it, right? It doesn't goes with the volume of the sales. It doesn't goes with the volume of production, right? For example, in January, the business may be low, right? If it is a business that is seasonal, I'm still going to pay the same amount of rent, right? If during December, when the business was in good shape, a lot of people were buying crazy, what I'm going to pay is the same amount of rent. Does it make sense to you? So such is a fixed cost to my business, like the example of a business that I gave just now. Right. So the fixed cost and the variable cost, they are not the same. The variable cost, it goes up and down depending on your sales. Right. For example, during the down period, January, no much sales for me. Right. So the money I will go and use to buy my stock will be less. I'm not talking about the unit price. Because, for example, if my sales, Jonga, follow this example very well. If my sales in January, in December, was 1,000 shoes, right? Because people were buying things for Christmas. That 1,000 shoes that I sold, I used money to buy 1,000 shoes, right? Which was a cost to me. Then I put a certain markup, then I sell it. Right. So in January, when the sales are down, I will not spend up to that amount to buy shoes again because there will be no point. If that the month of January I sold 15, let's say 5,000, and no, month of December I sold 5,000. Then January I know that I'm not gonna be able to sell up to 5,000, maybe 1,000. You see now the money that I will use to buy stock will be reduced. Does it make sense to you? So let's say during the month of February or March it increases or it has increased. Then I will now have to use more money now to buy stock. So the money that I will be using to buy stock depends on the sales volume, my sales. I don't know whether you understand what I'm trying to say. Do you get a picture of what I'm trying to say? Guys, do you understand it? If you don't understand, please tell me because this topic is very important. Very, very important. And it's something that you must know. You see? So if you don't understand, please tell me. I'm going to explain to you what we mean by variable cost and fixed cost, the difference between the variable cost and fixed cost. Right. If I'm making magunya, right, the materials or the raw material, what is going to cost me to make 5 magunyas is going to be less than if I'm making 10 magunyas. Do you get the point? Because if I'm making, let's say, if I'm spending 50 rand, or let's say 150 rand to make 5 magunyas, when my business increase, whereby I will be selling 15 magunyas, that means I will have to buy, spend more money to buy my materials to make my 15 magunyas. It's like you are at home, right? Maybe perhaps you have 5 people in your house, right? The money that you will use to feed 5 people would be less than the money that will be used to feed 10 people. Does it make sense to you? So it goes on and on. It starts fluctuating. It fluctuates depending on your sales volume. But the fixed cost doesn't move. It remains the same. Right. For example, now in a factory, when the production, okay, let me put it this way, when the sales are high, when the sale is high, what is going to happen? They would like to hire casual workers. You could notice that in ShopRite, you see what happened during the month of November, December. They do hire casual workers, right? They'll be looking for people to work for them. So during the month of January, when the business is low, what they're gonna do? They're gonna tell the casual workers to go, right? So in terms of the component of, or in terms of the wages, salary component now, it will reduce, right? It was high when the business was booming, right? Right. Then from there, I can explain to you that wages that are being paid to casual workers is a variable cost. Salaries is a fixed cost. Let me give you another example. You've got a business whereby you need to use your delivery van, right, to deliver your product. The more sales you make, the more cost you are going to incur in buying petrol because you need to drive around. Does it make sense to you? Right? So the cost of fuel is a variable because it depends on your sales volume, whereby you need to go around to deliver to so many places compared to if you have fewer places to make your delivery. Does it make sense to you? Who doesn't understand? Hello, yeah, very Kamala. Well, do you understand it? Okay, like your cell phone now, right? If you got many customers, if your business is growing, it's expanding, it means you need to make a lot of calls, right? What does it mean? The cost of you buying airtime to make calls will increase. So in a month where there is no business, where you don't need to make a lot of calls, then what is going to happen to the cost of buying airtime? It's going to reduce. So it goes according to the sales of your business or according to the volume of your production or the volume of sales. Does it make sense to you? This thing is very important. Click. Let this thing click on your brain. Very important. Do you understand it? Right. Now, when you've expended the cost, what's gonna happen? You need to sell your stuff, right? When you sell this product that you bought, you've expended money on, then you're gonna generate incomes, right? So now the difference between the cost and the income says you can call it income, you can call it turnover, right? Do you understand what I mean? Right. It could be an income, it could be turnover, right? It could be sales. So the difference between the cost of sales and your sales will give you profit. It can either be positive or negative, loss or profit. That is why they call it profit and or loss account. right? For example, if the money you use to buy your stock or to produce your stock is more than the money that you generated from sales, then this one going to be negative, right? So, like what is said here, income and expenditure, the difference between sales and cost, which is the leftover, is what we refer to as profit. Do you understand it? If I bought an item for 5 rand and I sold it for 10 rand, what will be my profit? 5 rand, right? That is the leftover. Does it make sense to you? Right. Who doesn't understand? Anybody? Okay. Can we move now? Proceed. Can we proceed? Okay. So these are some of the terminology that you need to understand, right? Sales can either be called turnover, right? Or income. It can as well be called revenue. Revenue. When you make sales of your products, then you generate revenue. You can call it income or turnover, right? The cost is the expenses or are the expenses that you incurred during the course of you running the business. Profit, net income, right? Okay, there's an example here. I don't know why. You got your books there. Page 869. Page 69. There is what we call gross profit. Gross profit and then net profit. So when you remove the cost of sales, what it costs you to make a product or to buy a product, and then from your sales, you have the gross profit. Then the gross profit, you haven't removed all other expenses. When you remove all other expenses, then you have the net profit. Right. For example, you got, they say the owner of a small corner shop, are you there? The owner of a small corner shop has forecast monthly sale of 10,000 rand. When they say forecast, that means it's futuristic. It's a forecast. It's like a prediction that is going to make a monthly sale of 10,000, right? When they say forecast. Then his fixed expenses are 2,000 per month, right? He has calculated, are you there? Okay. He has calculated that he needs to buy goods to the value of 5,000 to generate the forecast sales figures. Right. Now, therefore, you see, he says for the forecast, that is the sales here. This says 10,000, right? Then the cost of sales, which is this one. Where is it? This Chinese stuff? Is this battery finished now already? Okay, this one. Cost of sales. Then it's 5,000. So what is the gross profit? 5,000. Remember what we said, very, very important. Take note. When you remove the cost of sales, what it costs you to acquire the product, the direct cost from your sales, you got the gross profit, right? The gross profit. Then you need to remove again any other expenses that you have incurred, right? Okay, here now they got a fixed cost that have been incurred, which is 2,000. So when you remove 2,000 from the 5,000, then you have the net profit. Do you understand it? Gross profit, it has to do with the cost of sales and the sales. We are not talking about the expenses that you've incurred. In other expenses, I mean, we are not talking about other expenses directly on that product. You see, then you will have the gross profit. After the gross profit, you remove all other expenses to get the net profit. But you're gonna understand it during the course of as we move along, right? I know most of you are not. This is your first time of coming across this type of terms, but what I can assure you is that you're gonna get used to it. You will know it. I will take it easy to make sure that you know it by the grace of God. Then that is how to work it out. Then they say gross profit, as you see there, sales minus cost of sales. Gross profit. Then minus fixed cost to get the net. That is how to work it, right? Then go to page 70. 70. Gross profit percentage. How do you work out the gross profit percentage? This thing is very, very important. Guys, we are going deeper now. Very, very important. Right. How do you work out the gross profit percentage? Right? You say the gross profit percentage is the gross percentage of a business expressed as a percentage of sales. Right? You see your gross profit, you express it as a percentage of sales. Right? For example, listen carefully.